All right, guys, I'm back. I apologize for not posting recently. Just kind of been busy, refinancing some things and kind of getting ready to hopefully purchase some more property. But I wanted to get back with you guys, create a new video, and today we're going to be talking about the housing market, where it's going, inflation, the housing bubble, is it coming? Um, I've been spending the last several weeks watching other people's YouTube videos and on the housing market, and some of the things that they've been talking about just doesn't ring with me, and I've kind of have a different view and a different opinion, and I don't know why anybody else is not picking this out. So I kind of want to bring it up to you guys, give you my thoughts on the subject matter, and let me know what you think. Drop a comment down below. I will read them and I will get back to you. But before we start here, just need to ask a favor from you. Please help me triple D this video and channel. So what I need some help from you is just help me define this video by smashing that like button. It doesn't really cost you anything. Develop this channel by subscribing down below. And then most importantly, help me deliver this video by sharing it with someone who you think might benefit from the information. And best of all, this doesn't cost anything. It's free. And that's a double D on your triple D. So let's get into this. So with the housing market itself is, to me, it's almost like a perfect market as far as business is concerned. It's your basic supply and demand channel. And so if you understand supply and demand, you'll kind of see where the housing market is and where it's going. And I really want you guys to understand this. So I'm going to do some demonstrations here for you guys on the supply and demand curves, how they work. And if you understand this and how everything fits together, you will kind of see how this is moving forward. And I try to make it as simple as possible, as basic as possible, so that you guys can understand this. So let's throw up some graphics and we'll kind of explain it to you. All right, guys. So this is your basic supply and demand graph chart, whatever you want to call it. So I want to make this as basic as possible. Again, this is stuff they should have taught you in school, but they never did. But to make this as basic as possible so you understand it, because this really applies to everything in several different aspects. So if you understand a few of these basic things, you'll see how all this fits together and why I think the way that I do. So the housing market itself is like a very basic supply and demand curve. In a perfect market, this is how products work. So you have a certain amount of supply of products and you have a certain demand of products. And where these two intersect is where you're going to get your ideal price and your ideal quantity. And so the way that these work, so let's take the housing market as what we're talking about. So based on the supply of the market and based on the demand of the product, we have a price and a quantity that we're selling. And so what happens is as the price goes up, so let's say that this is the ideal spot of where you want to be, where they're both supply and demand are equal in each other. If you want to charge a higher price, which as it goes up here, so if you want to charge a higher price, you only have the demand for here, but your supply, so this is your price quantity, your price amount, and then the supply quantity actually is way over here. So if you raise price, you're not going to be able to sell. So it kind of equals itself out. So now what happens is there's two things obviously that affect this price and quantity match is supply and demand. So if demand increases, it moves right. So as the demand increases and it moves right, you can see what happens is the price starts to go up. So as your demand goes up, so does your price. So the price goes up as well. And when the demand comes down, the price goes down. And same thing with supply. When the supply goes up, which means it moves to the right, so when the supply goes up, the price goes down. So when the supply goes down, the price goes up. And so this kind of lets you know kind of how everything fits and what affects the prices and stuff. So when you listen to the guys out there on the internet and they're talking about, well, the prices are going to come down. Well, why are the prices going to come down? The prices are going to come down for one of two things. Either the supply is going to get cut, or so if the price is going to go down, the supply increases. So if the supply increases, the price will go down. And that's what they're talking about, like forbearances and foreclosures. So if all that stuff starts to happen and they start to flood the market, you could see a price come down just because of the supply. And vice versa, if the price is going to come down, then that means the demand is going to have to go down. So those are the two things that will affect the price. So anyway, it's very important that you understand this and just these really basic things. The supply and demand are going to affect the price and the quantity of houses that sell. And so what has happened recently is that the demand is actually increased. And that's why the pricing of homes is going up. You have investors, you have hedge funds, you have those type of people that are coming in and wanting to buy houses. So when they come in to buy the houses, this demand starts to shift. And so that starts to raise the pricing. And again, the reason why the quantity goes up is, well, how come the quantity goes up too? Well, because as the pricing starts to go up and up and up, in theory, what happens is that more and more people are willing to sell. So like if your house is worth $400,000, so this is the ideal spot. So if you're going to sell your house and it's worth $400,000, you're going to sell your house for $400,000. If somebody wants to give you a less price down here at $350,000, there's less people that want to sell. So less people are going to sell for the less price. On the flip side, if the price starts going up, more and more people are willing to sell. If somebody wants to pay you $500,000 for your $400,000 house, you're going to sell it. And so, that demand, the high demand tends to go up. And so what happens is you don't have a supply right now. And so when the supply is not there and it doesn't meet your demand, what happens is you start getting more offers for the house because there's no supply. That's why you're getting, 10, 20 offers. And when you have more demand than supply, it raises the price. So that's just so you guys understand kind of how this works. And now we're going to get into, why this isn't going to crash. In order for the price to come down, like we said, either the demand goes down, which means the pricing goes down. So as the demand goes down, the price goes down, or as the supply goes up. But since we have such a high demand right now, we don't have the supply to keep up with it. And, if you guys have been out there trying to buy a piece of property, you know that there's been multiple offers. So when you have 20 offers going in for one house, that just lets you know there's 20 people for every house that's out there. So that means there can be 20 more houses on the market and somebody would buy them. So we have such a high demand right now, it's going to take a while for that to equal out. Now, the other thing that's going to happen, so, we already talked about what's going to drive up the supply. So what could drive up the supply are foreclosures and forbearances. If the people aren't paying their loans or they can't qualify for their loans anymore, then there's a chance that some of those are going to come on the market. So there is a chance that the supply can get increased. But again, I think that the demand is so high that supply is just going to be absorbed into the market. There's not enough of it to account for it. So the other thing that's going to drive down prices is the demand. So what is going to drive down the demand? Well, there's one big thing that's going to affect the demand, and that's interest rates. So when you can't buy a house for the same amount of money that you could before because of interest rates, that's going to drive down the demand. So again, these whole things go into effect. So if you understand the supply and demand structure, this goes for everything. So this also goes for inflation. You've heard the word inflation.
But what really is inflation? All inflation is, it means that you can't buy as much with your dollar that you used to. And so a lot of people go, well, inflation is going crazy and we're just going to have to pay more and more for things. And that is what's going to happen. And again, we go back to the supply and demand curve. So what has happened to the supply of money? The supply of money has increased. So as the supply of money has, the government has basically printed trillions and trillions of dollars. So when the supply increases, as it starts to shift here, what happens? The price of the money goes down. So when the price of money goes down, the value of the money goes down. So that's what's happening. They've increased the supply so much that what you can buy for your dollar is going down. Now, there's a couple ways to look at this. So while there is inflation, the way to combat inflation is to invest in things that will continue to go up. So if you are investing in the dollar, meaning you're putting money into your checking account, your savings account, and you're hoping to save up that money to tomorrow buy something else, or to next month buy something else, or next year buy something else, you're going to be able to buy less because inflation is going to eat away at that. So what you need to do is you need to invest in things that appreciate or that inflate and go with the market, which is, stocks, gold, silver, real estate, the things that tend to inflate and keep up with inflation. And I know it's kind of a vicious circle, because how do you put money into real estate if you don't have the money to buy real estate and you can't buy it? But again, unfortunately, this is what's going to make the division even more, because those that can't afford it and those that do have it, their assets will continue to rise, while those that can't afford to buy things, their assets will tend to drop and they will have less savings. Now, again, this market is this channel is for everybody. And so I want to leave you with some things that, regardless of where you are on the spectrum. So if you can't invest in assets, you can't go out and buy a house right now, inflation is going to affect everything. And so everything is going to tend to go up. This means all your consumer goods. And so, but why is inflation going up? The reason why inflation is going up is because things are costing more. So you've heard the Fed talk about transitory. They want to keep saying that inflation is transitory. It's transitory inflation. It's kind of a buzzword that they use. But what does that really mean? All transitory means is that it's moving. It's not permanent. And so when they say transitory inflation, they say that it's temporary inflation is what they mean by that. So what would cause temporary inflation? Temporary inflation is just short-sighted things that aren't permanent. Like the pandemic, the pandemic is short. It's 6 months, a year. Well, it's been longer than most, but the idea was that the pandemic has, it's going to end, and so it's over. Another big thing is like the lumber pricing. The lumber pricing was a supply issue. Again, the supply, because things were shut down because of the pandemic, the supply moved down. We have less supply, which means the price goes up. You see how these things correlate. So when you have less supply, the prices go up. Why are my fuel prices going up? Because the government shut down a pipeline. And so when you shut down the pipeline, you have less fuel, you have less supply. The supply moves left. So as the supply moves left, the price goes up. And so it's basic supply and demand. So those go up. Look at the wages that are out there. So when you have employers and we have no workers, the supply of workers goes down. What happens? The price goes up. So you're having employers having to pay more to try to get employees. And so, while on the surface this seems great, but what happens is this is a permanent thing. This isn't transitory. So if an employer has to pay more money for the services that are going to make their product and that provide their product, what happens? They're going to have to pass that cost on. Same thing with the fuel pricing. That's not a transitory thing. They've shut down the pipeline. There's going to be less gas. Your fuel prices are going to go up. Well, what are fuel prices used for? They're used to transport everything. So if it costs more to get things to your store, if it costs more to ship things across the country, what's going to happen? The prices are going to go up. If it costs more to hire the guy to stock the shelves, if it costs more to hire the guy that's going to check you out, if it hires more for the guy that's going to bag your groceries, it's going to cost more for your groceries. Those things have to get passed on. And these aren't transitory things. So when there's things that go into place that are permanent via wages, via transportation costs, that's not transitory, that's permanent. That means inflation is coming more and more and more. It's going to be more expensive. Now, the plus thing is a lot of people are looking at the cost of housing going up and looking at that as in today's dollars. And so that's kind of the error, I guess, in that. You're looking at what can I buy today based on my dollars today. But you know what? If you're working, your wages are going to go up as well. And so as your wages go up, you're going to be able to buy more with your wages. And the other thing too that is huge is when you are out buying a home, when you qualify for a home, you're not qualifying based on the house. It's not I'm buying a $300,000 mortgage or I'm buying a $400,000 mortgage. No, what you're buying is I'm buying a $600 payment or a $1,000 payment or a $2,000 payment. It's your payment that you're qualifying for. It's not the quantity of the house. So, if your wages go up, just as a rule of thumb, I tell you guys before in my other videos, the rule of thumb is between 30 and 35%. So if you take your salary, let's say that it's $3,000 a month. So if your salary is $3,000 a month, you can use about 30 to 35%, which is about $1,000, is what's going to be used for you to qualify for a loan. And if you and your spouse are working and you're both making $36,000, you're looking at about a $2,000 house payment. So the $2,000 house payment is going to be what you guys qualify. Now, if you guys are going back to work and instead of $3,000 a month, you're making $4,000 a month, it means that you're going to be able to buy a bigger house. So your salaries are going up, so is your ability to pay for a house is going up as well. That's why you have to look at your house payment, not the price of the house. And the one thing that the government has been doing so that you can afford a bigger house is to do what? Is to keep interest rates low. So when interest rates are low, that's based on your income. And so the more income you have and the lower the interest rate, the more that you can afford to buy a house. So what's going to change then is when the interest rates start to go up. When the interest rates go up, less people are going to be able to buy a house. So now that you guys understand supply and demand and kind of how that works, I want you to see why inflation comes and how it's going to affect the housing market. And one of the things that most people are familiar with Zillow. They know how Zillow works. They go to the buy, they go to the rent, they go to the sell, and they kind of look at things. But what I want you to do is I want you to scroll down to the bottom here. And if you see the bottom down here, there's a button called Research. And if you click on that Research button, you'll kind of see just some information that is out there on the industry. So here's mortgage rates rise on more hawkish Fed signals. So here kind of is the big thing. This basically just came out today. So, or the 16th, who knows when I'm going to release this. So the Federal Reserve's insistence that recent inflation figures were transitory. Again, there's that transitory thing. Are they temporary? Are they permanent? Well, they seem to think that they're transitory and that any changes to monetary policy wouldn't be necessary until the economy showed far more substantial progress, has kept rates at bay for months and in recent weeks. It's increasingly seemed that it would take a shift in this stance for rates to head meaningfully upward. At the June FOMC meeting, I don't know what that is, on Wednesday, the Fed announced that they expect to make 2 interest rate hikes in 2023. I did hear this. So this is kind of where we're saying that when interest rates go up, it's going to affect the amount of house that you can buy. Now they're talking about this in 2023. They're going to have 2 rate hikes in 2023 is what they're thinking about, and predicted higher inflation this year, a signal that they are now more likely to make some changes to policy than they were even just a few months ago. So what happens is, historically, the Fed doesn't just come out and raise interest rates. If the Fed is going to I've been watching this for a while. So if the Fed is going to raise interest rates, they will start talking about it ahead of time. And it's a way, I think, for them to kind of test the market and see what the reaction is going to be in people and see how much pushback that they get. And so what the Fed is doing is they're saying that the inflation is transitory, which means it's only temporary. And there's some truth to that when we talk about like the lumber shortage. That's a temporary supply issue, so that's going to change. But we're also talking about the increase in salaries and wages and the increase in transportation costs, that all of those things are not transitory. Those are going to affect inflation. And so as those start to go up and we start to see inflation go a little bit crazy, how the Fed is going to react is they're going to raise interest rates. Now, they're talking about 2023. So if they're already talking about this and we're a year and a half away, my guess is they're actually going to probably raise them by the end of 2022. But there's some more information on this Zillow website that I'll kind of show you. But what you need to be aware of is pretty much right here that on the 16th, Jerome Powell, and he's the one, if you don't know who he is, he's the one on the thumbnail. He talked about that they're going to start raising interest rates in 2023. But the housing market is scheduled to have huge growth this year, huge growth next year. So, is the market going to crash by the end of the year? No, it's not. Is it going to crash by the end of next year? No, it's not. Because interest rates are going to hit to 2023. Now, who knows what's going to happen, come 2023. But as they start raising interest rates, you're going to kind of squelch that demand a little bit. But, home prices are scheduled to go up 10 to 15% this year by the end of the year and 10 to 15% next year. So if you're kind of waiting on the market and you say, well, I'm just going to wait till the market crashes in 2023, you're probably going to see anywhere from a 15 to a 30% increase between now and then. So it has to correct quite a bit to even get you back to where you're going to be now if you get into the market. So here you go here too. Inventory finally rebounds as appreciation and rent growth break records. So this is something that I want you guys to see. This is what I was just talking about. So, Zillow is huge. They have tons of data, and Zillow expects home values to grow 15% between May 21 and May 22. So in the next 12 months, we're going to see a 14.9% increase in the home value. It's going to end, and that's from May to May. So we're talking end of the next year. By the end of 2021, they expect an increase of 17.9%. And that's from the beginning of the year. And this is why, again, that supply and demand issue that we were talking about before, existing home sales are expected to total 5.9 million in 2021. So that's up 5%. So you have more demand. So as you have more demand than the previous year, things are going to increase in price. The rapid home price appreciation that has marked the past year in housing is not expected to let up anytime soon, though affordability concerns and continued low inventory are putting somewhat of a damper on the outlook for sales, according to the latest Zillow home value and sales forecasts. Again, you got 14.9% growth. So Zillow actually reforecasted what they were doing, as far as what. So in May, a couple months ago, they thought we were going to be up here for home sales, but we actually ended up down here. And so year over year, kind of the same thing. They thought they were here for growth, but they were way up here for growth. So appreciation is hitting. And again, this goes to what I was telling you guys. The housing market is not going to crash for a couple years, and we're going to continue to see growth. And even if we do see growth, what's going to happen? I mean, you're talking about a 14-18%. I mean, you have to know your market too. I mean, this isn't across the whole board. Obviously, there's going to be some sub markets that are not doing as good as some other sub markets. So again, when there are indices of kind of where the market's going, there's indices that kind of predict the past, and there's indices that predict the future. And so new home starts is an indice of where the market is going. And so you want to see new home starts going up for the market to keep going. So here we have 1.5 million homes were started in May, up 3.6 from April. And they're up 50% from May of last year. So housing permits, again, this is an indices of moving forward. So moving forward, if people are pulling less permits, the lowest figures. So that's kind of an opposite thing. Housing completions fell. Well, that's, I think, partially because of inventory issues. They're up 16% year over year. Here's your demand. Again, our supply and demand. Our demand for housing remains in overdrive, but supply side constraints have left otherwise eager home builders struggling to find a higher gear. Again, I guess that's the supply issue. So what's that do? It just kind of raises the prices. So here you go here too. Year-to-date housing starts are up 27.9% from the same period in 2019, pre-pandemic. So guys, there's so many indices that are showing that the market is not going to crash for a few years. And even when it does in a couple years, I don't think it's going to crash. It's going to kind of taper off a little bit. They're going to try to slow things down a little bit. But you're going to get pushback too if the government tries to raise interest rates too fast. So it is kind of that yin and yang thing. But I mean, I think we're talking 2 or 3 years before we start to see a correction a little bit. So it's where's the top, where's the bottom? Who knows? There's always the wrench of what the government's going to do. If a government intercedes a little bit more, they can keep pushing the forbearances down the road further. They can start working. I mean, as what's going to happen when you start evicting all these people from the homes? And if you start evicting them and now they're trying to go rent new places, and new landlords aren't going to take them in because they didn't pay their last rent, and now they have an eviction on their record. So you're going to have millions of people that have evictions that are no longer going to be able to rent. What's going to happen there? There's going to be lots of outcry, and you can't put all these people on the street. So, who knows what the intervention is going to be with the government in the next 6 months from eviction standpoint. So one of the things I want to show you guys too, kind of the 10 strongest performing markets over the next 12 months. So this is the forecast from first quarter 2021 to first quarter 2022, what they think the increases are going to be. And we kind of saw that with the Zillow as well, kind of their forecast, that 12 to 17%. So here's kind of the top markets that are moving right now. You got Boise, Idaho, and Coeur d'Alene. They're both at 17-15%. And then you got the Phoenix area at 13. These are all double digits. So kind of everywhere we're looking at double digit growth. And here's the worst markets. But even the worst markets, as you see, over the next 12 months, they're still looking at growth. So even, and I don't know anything about any of these areas. Maybe Monroe, Louisiana. I prefer those. I haven't been to any of these places, but maybe you guys are more familiar. Drop a comment down below. Let me know what you think of these, if these are kind of accurate or not. But this is what we're looking at. But you guys, I wanted to give you this resource too, that you guys can start, going through this. There's housing data here. You can go and go through your actually county and city. This is the Metro US. You can pick a state and kind of get information for your state. You can get information for your county, for your city, for your zip code. And it'll download into a spreadsheet. You can kind of see what things are doing and what trends are doing. But anyway, just want you guys to be able to know about this, kind of what the inventory is. You can go off rentals, list price versus sales price. This is a great resource that they put together, and it's all free. You can go to some visuals, and these are just graphs that they've already put together. So this is year over year, the change in inventory. You got active listings, they're down, new listings, kind of pending. This is for month to month, but there's just some interesting information here. You can go for buying and selling. You can see the graphs that are geared specifically for buying and selling. Here's West Coast metros. So here's another thing, guys, is that a lot of people say, well, we're just going to have another 2008. You think we're going to have another 2008? Here's an article of why we're not going to have another 2008. Essentially, the fundamentals have changed. So to me, there's two big reasons why we're not going to hit a crash like we did in 2008. One is, for those that have been around, remember that in 2008 there was a lot of speculators. You had people that were buying homes that had no intention of moving in, no intention of renting them. They were going in and buying because the market was going so hot. They were buying new homes. It was taking 4 to 5 months to finish the home, and by the time the home was finished, they were selling for $50,000 to $100,000 more than what they had started at, and they were just flipping these homes. And the difference is, that's still a good strategy if you can find a home builder that's building a new development. The difference is, back then you didn't have to qualify. What they were doing back then is they were doing stated loans. So you basically told the mortgage broker how much money you made. They said, well, in order to get this loan, you need to make $200,000. And people were going, okay, well, I make $250,000. There was no documentation. It was an undocumented loan. And so it just kind of went, they pulled your credit if you had good credit. It was just a no-doc loan. And so when you had a no-doc loan, it would go through. You might maybe paid 0.5% more than a full doc loan, but if you were going to flip it in 6 months, you really didn't care. And so you had these undocumented loans that were going through, or no-doc loans. And what happened is eventually there was no buyer for it. So if there's no buyer and you had no intention of moving in, and then it went back to the seller, or they foreclosed on you because you didn't close on it, or you had already got the loan but now you couldn't sell it. So that was a big part, is the loans. And in the loans, that's no longer the case. You actually have to qualify for the loan now. They're not doing no-doc loans. And so the qualifications are much stricter and much harder to get the loan. So that was a big loophole that they closed, or a big problem that they closed. And then the next thing that is huge, you're talking in 2008. So this is 13 years ago. Well, what's happened in the last 13 years? So what's happened over the last 13 years? Right here, friends, millennials. The millennials are aging into home buying. So here we go right here. The median age for moving out of your parents' house and basically buying a home. So between 26 and 34 is when most people buy their first home. And so you can see that peak of millennials. They're coming into age And so the median age of the first-time home buyer in 2019 is roughly 46 million. So the median age of first-time home buyers in 2019 is roughly $46 million, the largest such number expected to reach that age in a single decade. The previous record prior to the millennial generation was in 1989, when there was about 43 million 25 to 35-year-old boomers. So we have the next generation coming in. So you saw a big boom in the industry in 89, and now we have a big boom coming now, and it's a much larger population. And there are millions more of their younger peers and Gen Z behind them waiting in the wings. So the population is growing. All of the millennials are starting to go out and buy homes. They're starting to move out of their apartments and starting to buy homes. So again, that's supply and demand. As the demand goes up, so does the price. You got the Gen Zers that are right behind. They're going to be looking for homes too. So anyways, just wanted to give some of these things to you guys, some resources that you can check on your own, research on your own if you're interested. So as we see this, I mean, this is the S&P CoreLogic Case-Shiller or U.S. National Home Price Index. So this is kind of, what are home prices doing, and this is kind of year-over-year pricing. Again, we've seen this in several different studies here through Zillow. Up 13%, up 12%. The annual growth in the top 20 indexes is up 13% from 12%. The 10 city index is up 12% from 11. Phoenix is up 20%. San Diego up 19. Seattle up 18. So the market is just continuing to grow. While signs are emerging that the consistent decline of for sale inventory is beginning to slow and could be on the verge of reversing, the pressures that have pushed home prices upwards at their fastest pace in years remain in place, and prices continue to press higher. Again, this was May 25th, so this is a couple weeks ago. So it is a little bit older, but it's not that old. So this is what they were forecasting. So they were forecasting this in 427, and then a month later, the actuals are actually higher across the board. National year over year, 12 to 13%. Again, guys, this is what I was saying, that you could wait 2 years till 2023 to buy, but you're going to be behind 25%. So you're going to be behind 25% in value, and then you're also going to be behind because of interest rates as they start hiking the interest rates. Well, there you go, guys. I mean, we've covered the supply and demand. I've kind of told you why, what some of the transitory things are when we talk about, the temporary issues, like the pandemic is getting ready to end, like the lumber pricing. The lumber pricing is just a short-term thing, and that's starting to come down already. So there are some transitory things, but they're very minuscule. Then you got the permanent things that are coming into place. You got the younging age millennials that are buying houses now. So you get that much larger market that's coming up. And then you have the millennials that are getting out of apartments, that are buying homes. You also have, and then we've talked about inflation. So the inflation is a big impact, but the non-transitory inflation items, meaning wages and salaries, those are going up. That's not going to change. And so when you have those wages and salaries going up, that's going to push inflation up. You have energy costs. Your energy costs continue to go up. Again, that lack of supply increases the price. So when you have less of it, the price goes up. So all these things are going to lead to inflationary pricing. Your cost of goods are going to go up. So when that happens, so is the pricing of houses. They're going to go up as well. And you have that pent-up demand with the larger quantity of people buying houses.
And again, originally when this whole thing started, I thought that this was a supply issue. And a supply issue being that, people were locked in their homes, they were scared with the pandemic, they didn't want to list their house because they didn't want people into their house. And when you again go back to the supply and demand, if nobody's selling their house and you don't have that supply, then the pricing is going to go because you have a lack of supply. But if you look at the actual numbers, we are actually selling more houses now than what we sold pre-pandemic. So that lets me know that it is a supply issue, but it's not a supply because of the inventory. It's actually a demand issue. You have a much higher demand than the possible supply that you have. And so when you have a much bigger demand than the supply, what does that mean? Prices are going up. So it's going to take a few years just for that supply to equal out to the demand. So these prices aren't going anywhere for a couple years.
Okay, guys, I wanted to show you a couple more graphs, infographics here, and just kind of explain too why I'm coming where I'm coming from. Remember when I said before that it's not a supply issue, or it's a supply issue, but it's really a demand issue. And this is the graph that I was talking about. So as you can see, this is number of existing homes sold in the United States from 2005 to 2022. So as you could see in 2005, this was kind of pre-pandemic. So obviously pre-crash. So the pre-2007-8 crash, we were selling 7.08 million homes. And then the trend dropped a little bit, and then of course it crashed in the 2008 crash there. But then it started to go back up, and you could see in 2020. I mean, you could see this trend already going from 218, 219 was kind of stagnant, but then we went to 5.64. 2021, we're scheduled to hit about 6.49. Now, a couple things happens here, and then these are projections. So projections for 2021 and projections for 2022 are 6.49 and 6.44. These are huge numbers compared to what we've done over the last 3, 4, 5 years. This is why I'm saying it's not a supply issue, it's a demand issue. We have more people buying homes than what we have available to sell. So even if we sold the same amount of homes we did in 2018, 2019, we're not even close to meeting that demand of what people have. That's why the prices are going up. So we just need to actually manufacture more homes and sell more homes. So what is the difference here, guys? Well, the big difference is you have a lot of big suits buying homes. You have the hedge funds and the different people that are going in, buying up whole neighborhoods because of this growth. I mean, we've seen where just the appreciation is 10, 15, 20% year over year over year. That's a huge return just on the appreciation. But when you're looking at, now you got cash flow, now you have, the tax write-offs, all of the benefits of real estate on top of that, you're talking huge returns for these hedge funds. That's why they're buying these things. So that's just one reason. The other reason is millennials. I talked to you guys earlier about millennials. That's the difference between 2008 and 9. That's why there's such a huge growth. It's because the millennials are now entering the market to buy, and they're huge. And just to kind of show you another graphic here. So here's another graphic put on by Realtor.com. And these are primary resident mortgages originated by age. This is across the whole United States. Now, this is as of 2020. So all of last year, you could see millennials alone make up almost 35% of the market. And not far behind, you have the Gen Zers, the 18 to 24 year olds, and a little bit younger than this even. I mean, they're coming up right behind. It's not going to be too long before they're taking a bigger percentage too. So our demand is going up. So that's why I don't think the market is going to crash. There's just there was too much pent up demand. We have too much increased demand. We just don't have the product. So there's no product. There's no supply. And so you're going to continue to see these prices going up. Now, again, what's going to change is when they raise the interest rates. Okay, when the inflation, they're keeping the interest rates low, but the result of keeping the interest rates low is we have inflation. And so unfortunately, once the inflation starts hitting, you're going to decrease your demand. Now, we're still going to sell homes. They're still going to go up in value just because of the cost of building the homes. But eventually, the supply and the demand will kind of equal itself out. So as less people buy, you're only going to have really, unfortunately, the wealthy and those that can afford with the higher interest rates that are going to be able to buy. So instead of getting into these situations where you're getting 10 or 20 offers, you're going to get down back to, 2 or 3 offers. Then eventually, as they raise the interest rates more and more, and it becomes less and less beneficial to buy a house, then you're going to be getting 1 offer. And then you're going to kind of get a level plateau of pricing. Will you ever get a crash? You could eventually, but then again, you got the Gen Zers that are coming right behind, 5 to 6 years down the road. That category is going to move up as well. And as you can see, the 35 to 44-year-olds still make up a large percentage. But again, by the time you're getting to this point where it's going to start really tapering off, interest rates are going to have a huge effect. But as it starts tapering off, they're talking 2023. But in 2023, they're probably going to raise the rates 0.5%. So it's like these things are going to jump to 7, 8, 9%. It's going to take time to get these rates to go up. But again, as I showed you in, actually it was a comment in another video, as you raise rates, the amount of your loan payment goes up incremental. So a 2% raise in rates. So if you go from 3% to 5%, your payment goes from 12% or $1,200 to $1,600. That's a huge jump. So people just can't afford that. But anyway, I wanted to show this to you, let you guys know that it's because of the demand, because of the millennials, they're coming through, and they're getting ready to buy, and they're making money. You're getting, a lot of times you're getting double incomes, and so you're having these larger salaries are going to be able to afford houses. But anyway, just wanted to throw this out there to you.
And then you have the Federal Reserve talking about interest rates. Even interest rates, we kind of knew that they were coming, but they're talking 2023. And you saw with the Zillow reports that the housing pricing is going up between 10 and 20% depending on your market. So 10 to 20%, even the worst markets are going up 2 or 3%, but 10 to 20% in your market. So you're waiting 2 years, you're going to be up 20 to 40% more than what you're paying now. That $300,000 house is going to be $400,000 house next in 2 years. So it's just something that you guys are going to have to decide for yourself if you can get in or not. And keep in mind, the other thing that's going to be the issue is interest rates. Don't look at the house of the dollar amount that you're paying. Look at the house for what your dollar can buy, what your interest rate is, and what your payment's going to be. Kind of the best thing for you guys to do is to get in to buy a house now if you can, and let the house appreciate with that inflation. That as the inflation continues to drive up that asset, you're going to coop that. It's better to be on the receiving end, being that you own the house and you've locked in your rent with a 30-year mortgage. So now you know that your rent's not going to go up with that rent increase, but your house is going to go up. Versus on the other end, if you guys stay renters, your rent's going to continue to go up over the next couple years, minimum, and probably 3 years plus. So, guys, this is just what it is. Knowing how this market works, understanding how the interest rates, the inflation, transitory or not, it's not transitory. There's a few transitory features, but most of it is not transitory. Just look at what they're charging or what they're paying now for minimum wage for McDonald's and stuff. They can't get workers to come in, even for McDonald's. I think McDonald's is actually a good job. There's a lot of these corporations where you get that stereotype of, you're flipping burgers. Look, it's a corporation. It's a great job. They're a huge company that is a national company. You're doing brand standards. There's a lot of things for young people to learn by working for a big company like that. You're creating a product that has brand standards with it. And so, don't poo-poo on those jobs. They're great jobs. But, the day of the 99-cent menu is going to be gone because just the cost is going way up. I mean, look at the size of the Biggie Fry, the Biggie Shake. Look at the size of the burgers. Either the pricing goes up or the quantity gets smaller, one or the other. But anyway, the point being is that inflation is here. Inflation is going to keep coming. If you can't buy a house, try to hedge against inflation and buy some disposable items that are things that you guys are going to use throughout the year. Like if you can't spend $15,000, $20,000 to go buy a house, spend $200 or $300, buying some extra toothpaste, some deodorant, some soap, some rice, the stuff that you're going to have to buy anyway, because the pricing of that is going to go up over the next year. So if you guys can even buy some smaller items that are and kind of lock in on the price, look at the sales. All these stores are trying to do little loss leaders to get you coming in to buy some items and hopefully buy more stuff. But the thing on your side is time. That these things are going to happen. The pricing is going to go up. So use those loss leaders to your benefit. Just go in and buy the loss leaders. I just went shopping at Safeway, and the Just For You stuff. They make you jump through so many hoops. But, you got ice cream for $1. You got, you got hamburger for $2.99. You got T-bones right now for $5.99, which is an incredible price. Bone-in ribeyes, $5.99 a pound. That's cheap stuff. That stuff's going to go up. Buy it when you can. Wrap it up. Throw it in the freezer. Now, food is one of those things you guys got to watch, because obviously that can spoil, and if your fridge or freezer goes out. But the consumable products are stuff that you guys can buy. Your toilet paper, your paper products, the stuff that you're going to have. That's just one idea for you guys that aren't in a position to buy a home, but at least still, if you're starting out, you can buy some little things like that. But anyway, understanding how all this stuff works together, well, that, my friends, is just a cost of living. We'll catch you next time. Drop a comment down below. I appreciate it. Smash that like button and subscribe to the channel. I really appreciate it. We'll get some new stuff coming out to you. Thanks.